I do a few things. I started my career as a financial advisor back in 2001, just 10 days before the World Trade Center went down. And I always joke that it was a time when I was 21. It was 60 pounds ago, so I looked like I was 16. And I was trying to convince people 3 times my age to trust me with their life savings at a time when the market's precipitously falling. Not an easy time to start, but that was where I started my career. I probably spent 19 years in the business before I started a second company called Elevate and Exit, where we help business owners basically grow their profits, de-risk, and ultimately exit their businesses for the highest profit possible to the right buyer. And then I started another company just actually last year called Adrenaline Advisor Consulting, where I help other financial advisors basically giving away all my secrets and teaching them how to grow a 7-figure practice like we did. So I would say those 3 things. We help both retail investors, for your audience sake, and business owners with everything from business transition and exit planning and involving their real estate. And for non-business owners, oftentimes we'll get people who own multiple properties that are in their, either, I think it doesn't matter if it's age dependent, but they might be in their 60s or 70s typically, and they're looking to get out of the real estate, but they don't want to pay the capital gains tax. Or it's a client whose mom or dad are looking to sell their real estate. And of course, the biggest problem is the basis is so low, they don't want to just get absolutely hammered on the tax bill. So we have solutions that we help both owners and non-business owners with. But yeah, I would say that's it in a nutshell.
Would this work for people that own a business right now, or are we talking about more real estate type professionals at this point, or both?
Both actually, yeah. If I give you an example of both types of person, we'll say both types of client, we would say a business owner example would be somebody who's owned a business, they're selling the company, and oftentimes the owner also owns real estate that their business resides in. It doesn't always have to be one property. It might be multiple properties, especially when you're looking at construction and more trades. But the business owner sells the business. The buyer typically signs up for a new lease on whatever the building is or buildings. And then oftentimes the owner wants to keep the real estate, but they realize in short order that they're just not that interested after all, whether that's because they don't feel retired still, or they just want to be done with it, don't want to deal with it. That's one example. The other example is somebody who they've worked for Microsoft their whole lives, and they've amassed 25 residential properties and rentals that they're cash flowing, and things are going great. And they just reach a point in their life, either A, where they're just done. They want to go more passive. They don't want to manage the real estate actively anymore. Or sometimes it'll be situations like I mentioned earlier, where we'll get a call from the son or the daughter that says, hey, my dad is so proud of this real estate portfolio he's built, but when he's gone, we don't want it. We don't want to deal with it. So we're trying to figure out ways that we can convince him to sell it, or he's ready to sell his real estate, but how do we avoid the taxes?
And what types of size are we dealing with here too? Is it like 10 single family houses, or are we talking about more large multifamily complexes or other types of complexes here?
That's a good question. It's actually all over the place. We've had large medical buildings on the commercial side with business owners. We've had multiple sales of properties for a company that does tree work for the cities and institutions. We've had individuals who have 14 different residential properties scattered all over the city, to somebody who had a 30-something unit apartment building. And we even had somebody once who had a $75,000 sale that we had to get an exception on because the minimum is typically $100,000.
Yeah.
So that was a really tiny example. So all over the place.
Yeah, that's cool. So basically this can help people no matter what they're selling. It could be business, it could be property, it could be big, small, all of the above.
If you don't like paying taxes, then
yeah,
this is an idea for you.
Exactly. Yeah. So let's jump into what you're talking about here. Like, how does all of this work?
Sure. Most people who understand real estate already know what a 1031 exchange is. And that's what it is. But it's a 1031 exchange into institutionally managed passive real estate. So as opposed to selling a medical office building or selling a multi-unit apartment or a single family home, and then having to go find another property to buy, like a like-kind property, what we're doing is we're buying institutionally managed property where you can expect a yield of anywhere between, call it 4.25%, upwards of 6 to 7%, depending on the property type. And it's all passive. You're getting paid monthly. You're a passive owner in this real estate. And then down the road, when it's sold, there's lots of ways to skin this cat. But let's just say hypothetically with a typical Delaware Statutory Trust, as they're called, when it's sold, you can just do another 1031 down the road. So you can basically keep 1031ing these things until you're gone, at which point the whole thing steps up in cost basis and passes on to the next generation tax free.
Yeah. When you're talking about 1031ing a property too, do all of the proceeds have to go toward that property, or what does that look like? Can you
That's
take
another good question.
funds
Yeah,
out, or?
you don't have to. Obviously, anything that you don't 1031 is going to be considered boot, and you're going to have to pay tax on at least a portion of it. So it's not like you have to do the whole thing or you don't get any preferential tax treatment. We run into situations where it's an all cash deal. So somebody has no mortgage on the property, and that's very simple, right? All we're looking for now is typically all cash DSTs, so all cash institutional properties, whether it be medical, office buildings, it could be hospitality, hotels, it could be storage units. So there's tons of sectors we can pick from. There's typically about 80 to 90 of these available at any given time. Obviously, once they're completely subscribed and, fully invested, then you can't be a part of it anymore. You got to wait till next time, right? Or till the new one pops up. But there's typically 80 to 90 available at any given time. And if somebody has debt, let's just say they have a mortgage on $1 million property they're selling, and they've got a mortgage of $400,000, then typically what we're doing is we're looking for properties or groups of properties that have a similar debt to equity ratio. Maybe we can find one at 41% or 42% debt to equity ratio.
So basically you're anticipating as much rolling over as possible, right?
Sure.
So,
If you want to avoid all the tax, yes.
Yeah. From a cash flow standpoint, what level do you have to transfer your funds over and live off of, if that makes sense? Let's just say that you want to make $60,000 a year. What type of money do you have to roll over to be able to make that kind of return on your money at that point?
Conservatively speaking, probably about 1.3 million.
Yep. Okay. Is there any other hoops that you have to go through, or is it just a matter of getting this list of 80 or 90 projects and picking out which ones work for you?
The way it works is you got 45 days to identify a property in a 1031, and it works exactly the same way with Delaware Statutory Trusts. So whether it's active or passive, it's the same rules. So 45 days to identify that property, and then 180 days you have total, including that 45 days, to close on that property in order to avoid the capital gains tax. There are some hoops you need to jump through. One of the biggest challenges we face is we get calls, I'd say at least once every week, from investors around the country that are looking to do one of these and get our help. And oftentimes we'll get somebody who says, hey, my identification window ends next week, which is not fun.
Yeah.
We've got to move quickly, because the way the process goes next is once we take on a new client and we engage, then our first step is to go look at those, call it 80 to 90 different options we have after talking to the client, doing an intro call, figuring out what they like, what they don't like, maybe educating them a little bit. Now we want to narrow it down. Let's just say if it's $2 million of total proceeds, maybe we want to narrow it down to 4 to 5 different options. So we'll look for, instead of 4 to 5, we'll look for maybe 5 to 6 or 6 to 7, because we always want to have a backup, at least one or maybe even 2 backups, because if it takes too long and we don't get the property to close fast enough, in other words, we don't get the cash proceeds fast enough, then it's possible that one of the choices we picked could close to new subscribers, and then it's done. And now we have a problem, right? Because I guess we could always just invest more in the others we have remaining, but for the sake of diversification, we always want to have a couple backups. So once we have a few chosen and we narrow it down from, let's just say 10 down to 7, down to 6 or 5 or what have you, we're doing a bunch of due diligence. We're getting questions answered. For some people like to keep them in tax-free states, so we might hone in on only the tax-free states. So once we have those identified, paperwork is signed along with a qualified intermediary. We prefer to work with ours, but oftentimes clients will come to us and they already have a QI picked out, and so we'll work with their QI, and all the paperwork goes back and forth, and now we can relax and wait for everything to close. Once it's closed, then obviously you start getting your income on a monthly basis, and it works out beautifully. You avoid all the capital gains tax if you 1031 the whole thing. And if it's all done properly within the rules, then, it's a pretty magical thing. Pretty cool.
Yeah, that's interesting. What would you say are things that people should look out for when they're making these types of investments into these projects? What are the top things they should look for in properties, in real estate, and in opportunities that kind of mitigate the risks on the front end?
I think the first would be make sure that you understand the risk levels in each sector. Like earlier, I quoted that you might look at yield between 4.25 upwards of 6 to 7%. If you want 6%, you're probably going to be in the energy sector, and energy holds a whole lot more risk than, let's just say, storage units or multifamily or single family, even hospitality, nursing homes, medical. So we tend to lean a little bit more conservative. We don't push people down that route. And if they really push us back to say, look, we really want to take the risk, we encourage them to do it with a smaller portion of the money as opposed to the whole thing. So that'll be the first thing. The second thing would be making sure you're working with sponsors that have a good track record. Even if it's a company that's only been around, let's just say a DST sponsor has been around for 3 years, as long as the management has been doing it for a long time, I think that's still okay. But I think you want to make sure you're working with 800-pound gorillas, people that have been managing real estate for a long time, that really know what they're doing, have a proven track record of full cycle DSTs, real estate investment trusts, and so on, even if it's UPREITs, things of that nature. So that'd be the second. And then the last would be to understand the costs and the fees involved in these things, because first of all, there are very few financial advisors that even know these exist. There's even fewer people in real estate, whether that be investors or even realtors, that know they exist. And because there's so few people to understand it or know what these things are and how they work, when you take that small subset, a very high percentage of those financial advisors in our industry tend to charge commissions for it. And the commissions, in my opinion, can be absurd. So you're looking at a minimum of 5% commissions and plus dealer's concession, upwards of 9%. Now, that's the bad news. The good news is that you're not really paying for it. The DST sponsor is paying the financial advisory firm and the advisor and the broker dealer, if they're a hybrid financial advisor or broker. That's the good news. The bad news is that's still money that is floating out there, and we all know it's all part of the same equation, right?
Yeah. Yeah.
The way we do it, and I know there's other companies around the country that do it like we do, but we're a fiduciary, we're a fee-only fiduciary. So we just charge a flat fee. But at the example of $2 million, a $2.5 million deal, we would charge a flat fee of $14,000 to help a client with this. $7,000 to get started, and then the other $7,000 when we close, and that's it. They're done. When you look at 2.5, sorry, go ahead.
And when you're saying 7,000 or splitting it up 50%, is that upfront or is that after the deal is done at that point? So if it's a 5-year deal,
I see.
Are you waiting for that? Does it make sense?
No, the way it works is we would charge for $2.5 million, our fee would be $14,000. So we would charge $7,000 to begin searching for DSTs, doing the due diligence. And when all the properties are closed, which is again within 180 days at the most, then we would charge the final $7,000 once everything's done. Once the chips have fallen, the dust is clear, we're all done. And now that you might own that DST, that real estate investment trust, for years. And then we might not talk again until you're ready to do another one, until one of them liquidates and you're looking to do another 1031. So that's how we charge our fee. And when you look at that compared to the commission, and this is the catch here, by the way, is that the commission on a $2.5 million total proceeds, whether that's one property or multiple properties, would be $150,000 at 6%. That's typical. 6% is pretty average. So with us, the way it works is we only work with DST sponsors that will credit the client the commission, because we legally can't accept commissions. So we're just charging the $14,000 to do all the work, the due diligence, find the DSTs, the paperwork, obviously processing. And then when everything's closed, the client ends up with $150,000. So instead of $2.5 million, they end up with $2.65 million. Does that make sense?
Okay. Yeah, that does. So said another way, basically, and I don't know what the exact numbers are, but we'll just use round figures unless you can do the math in your head. So basically their return that they can pretty well count on is 5 to 6%, depending on what types of asset they are investing their money into. Does that make sense?
I would say that's fair. If we're using like the lower end of the range and say 4.5% would be your cash on cash yield, and then over time capital appreciation, because obviously we hope these things are going to grow as well in addition to the yield. So I think that saying 5 to 6%, including capital appreciation, is probably a fair assessment.
Yeah, that's interesting. And does this work with pretty well any type of asset? Is anything off the table?
Any type of real estate. So
Okay.
the laws have changed. It used to be that you could sell your business. You could sell a corporation and do a 1031 like this. Unfortunately, can't do that anymore. There are other things. There'll be another discussion for another day, like qualified opportunity zones where you can sell a business and a portion of the business proceeds can go into a QOZ, deferred taxes, get tax-free income, and then end up with the growth tax-free after 10 years. But like I said, we're opening up a whole new can of worms now.
Yeah, that's very cool. Can you outline what this might look like from a investor's point of view? They make this investment of $2 million. Can you outline the business plan, how you would go about doing this, like what this looks like from the investor's point of view? Because I feel like we've bounced around and told the story, but not in a way that most investors would understand.
Okay.
What does it look like from starting this to reinvesting, if that makes sense?
Yeah, sure. I think the first thing that would happen is the investor would know that whether it's a business owner with a commercial property, whether it's a non-business owner with their own residential properties, or it's somebody who's family member they're trying to help out. So we're starting with property that we want to sell. We have to identify first and foremost that we want to sell this property, but we don't want to pay cap gains on some or all of it. If I know that, then I think the next step is to make sure that I understand that this whole strategy we've been talking about exists, because we don't want to wait until day 40 of the identification period to try and find something in 5 days. So as soon as we know we want to do this, I think we reach out to somebody like myself, our firm, another firm around the country that does things in the same way, that charges flat fees as opposed to commissions. From there, it's having the first discussion with a company like ours to talk about how's this process work. First thing we're going to do is once you sell your property, we're going to start identifying replacements, right? 1031 replacements. So depending on the size of the total proceeds, if we're looking at $1 million, I think that 2 to 3, 4 at most is plenty. And the reason you probably don't want to go higher than that is because the minimums are getting higher over time. And if let's just say you have, I don't know, $100,000 property, institutional property that is, that liquidates, and then all of a sudden 10 years down the road, all the new minimums are $250. It doesn't matter if you had capital appreciation and your $100,000 property is now worth $120. You're not going to be able to meet the minimum on a new DST. So now you're limiting yourself. So we recommend that people stick it to at least $250 per investment, upwards of $500,000. You can go higher than that, of course. If you start getting up into 3 million, 5 million, 10 million, now we're probably using bigger minimums, right? We're going to put more money into each opportunity because there's just not enough. There's not enough DSTs to diversify by $250,000 per property, right? So I think once we go through the identification period, that's where we're having a discussion with the client, and we're saying, the client says, look, I really don't like hotels. I don't like nursing homes, makes me nervous. Definitely energy off the table, too risky. Multifamily looks good to me. Single family looks good. Storage units sound great. So we hone in on the segments or the sectors of the market that they like, that they're comfortable with. And then of course, we have to filter for how much debt, if there is any debt, how much debt is inside the proceeds. Again, if it's a 40% debt to equity ratio, then we want to look for something pretty close to that. If it's 50%, then we want to look for something close to that. So the investors basically analyzing, I don't want to use the word analyze, I guess. They get to kind of look through the fact sheets, the very, very simple information that we give them, because we're not trying to turn anybody into an institutional real estate professional. Nobody wants to do that. So They get to look through very simple documentation, ask questions. We're usually answering a lot of the questions before they get asked, of course. And then from there, it's a matter of making the decision to which of these properties am I interested in doing a 1031. And then again, we want to have a couple extras. So we might sign identification paperwork using what's called the 200% rule, because that's how far above you can go, 200% of the total proceeds. And then once the proceeds start to come over, so the qualified intermediary is going to hold an escrow. They're going to hold the assets. That's how you make this all legal. And then as soon as everything's signed, identified, and the money's sitting there, and that escrow, that pot in the middle, we'll call it, then we close. The money gets released by the qualified intermediary, the QI. and everything is wrapped up and closed and we're done. And that's it. So it's actually pretty simple. The hardest part really gets done by us and the QI.
So, okay. Can you talk a little bit about the types of assets? Like you said, energy is too risky. Can you talk about some of the assets that you could have that are on the more risky side and these ones are more stable as well?
Sure.
What that looks like?
Yeah, I'm pulling up a report here that we look at all the time. I'll go through some of them. This is some of it's old data, so I'm not going to quote any specifics, but energy a few months ago, we'll just say there was 2 energy DSTs available. That was it. And they were paying 9 and 8% respectively. Oh, you know what? I think another thing to point out that you mentioned earlier, you mentioned what things should people look out for. I think another one is how long it's been on the market. I think if a property's been on the market for longer than 150 days, you probably don't want to touch it just because it's not getting enough interest. There's something there that somebody knows that somebody's not saying, if that makes sense.
Yeah.
So I like to stick to newer properties, but energy, we mentioned being risky. Hospitality, I like hospitality. Some people don't. Industrial, though, is great. Your warehouses, especially with the rise of Amazon servers, Amazon warehouses, AI. So there's always a lot of industrial and warehouse space out there. Multifamily, I think we're living in a country right now that has somewhat of a housing crisis. There's not enough homes and prices are getting really high. So people are looking for places to rent and they're struggling to find them. So multifamily, I think, is great. Student housing is another one. I think student housing as well as hospitality, like hotels, I think the reason those two sectors make people nervous is because they have COVID really fresh in their mind. And they worry that all of a sudden another COVID happens and nobody's going to the dorms. But I like student housing. I think it's a great diversifier. Office space, medical space. There can be really specialty REITs like airports, things like that. Retail is one that I really shy away from. If it's retail, I want it to be big box retail, your Home Depots, Lowe's, things like that. I'm not really interested in strip malls, for instance, but that's just a personal opinion. But then self-storage would be another one I love. They don't pop up a lot. You don't see a lot of them, and then senior housing, which I don't think is going anywhere anytime soon.
What does it look like from a velocity standpoint? Like you mentioned, the self-storage doesn't normally pop up or anything like that. How often do these opportunities present themselves, if that makes sense?
Yeah, I think there's new ones coming about all the time. I got an email today from one of the sponsors saying, hey, we've got a new one coming out right now, and here's what it is. And I didn't read the email yet, so I don't know specifically what they're releasing, but there's new ones popping up on the market all the time. So that's why I say that you can expect there to be 80 to 90 at any given time. I would say that, I don't want to say the majority, I would say probably 2/3 are typically cash, all cash, with 1/3 having some sort of debt to equity ratio. You'll see ones with 64%, that's high, and then ones as low as say 35%, if that makes sense.
Yeah, that does make sense. Yeah, I feel let's take this into consideration too. Investors have a lot of interests that they may be interested in. It seems like you're offering a very secure way of investing in these assets. What does it look like from a allocation standpoint? You get 50% and 50% goes over into more speculative type things. Yeah. So I'm curious what you would suggest from a cash flow or future perspective, like how much allocation should go into these types of assets versus a business. Let's say they have background in business.
Yeah, that's an awesome question with a huge answer.
Cool.
I think the whole thing would have to start with a financial plan. Anytime we start talking about risk and allocation, I don't think that it makes sense to go online and do a 14-question questionnaire and say, oh, here's how I scored. This is how risky I should be. I think we need a little bit more deeper analysis than that. Business owner or not, it doesn't make a difference to me. A deep dive into personal finance, understanding what their income sources and their expenses are now, what we expect those income and expenses to look like, both fixed and variable in the future, or I should say what they want them to be. I think we want to make sure that conservatively speaking, they're going to be able to hit every item on their bucket list with a relatively conservative rate of return. Because if there's going to be surprises, I want them to be good surprises, not bad surprises, right? We don't want to shoot for the moon and end up with something less. I think that risk is one of those funny questions where you really have to dig deep beyond a risk tolerance questionnaire and get into a financial plan to figure out, what do I need? What do I need to make work optional someday, or at least have the choice to quit working when I'd like to? If I want to keep working, I can, that's fine. But that's the first question, because most people don't just have real estate, even real estate investors, business owners especially. You got real estate investors are going to have their real estate. They're going to have cash. They're going to have investments, typically in 401k, IRA, Roth IRA, things like that. So when we start talking about how risky we want to be, we might take more risk in our investments that are in the market, the stock market, as opposed to the real estate. Or we might take more risk in, say, an energy DST and try to shoot the lights out with a 9% yield and hope for a bunch of capital appreciation. But we might be more conservative with our investment portfolio on the traded side, right? With business owners, though, now you're talking potential cash balance plans, because business owners can not only save money from the standpoint of their 401k, they can do it through profit sharing in a 401k. If they've maxed out profit sharing, they can set up what's called a cash balance plan, which means that, say, somebody who's 50 years of age could probably put away anywhere between $200,000 to $250,000 pre-tax. So in other words, a $200,000 to $250,000 tax deduction every year going forward until they retire, say at 60, 62, 65, what have you. There's actuarial calculations that need to get in that. But so that portion might be more conservative because it's supposed to be. So maybe we can take more risk with the real estate then. So I think you have to take all the variables into account. And for me, it all starts with putting together a plan. So earlier when you said what would be the business plan, what would that look like? For me, the business plan would be having a full-blown comprehensive financial plan that includes retirement planning, retirement income planning, tax planning, insurance planning, and estate planning. On top of that would be, of course, business transition and exit planning for the owner, if it's a business owner.
Yeah, that makes sense. What about, you mentioned like IRA money and all of that. They have money set aside in an IRA. They're going to use that to invest in. Is there any limitation to what can be invested at that point? Or, are you basically open to everything?
It depends. If somebody has a 401k or a 403b or 457 deferred comp plan, they're all just tax codes to the IRS, but they all mean the same thing. They're pre-tax employer-sponsored retirement plans. So if I'm a real estate investor and I'm not a business owner, I probably had a full-time job at some point, or maybe I still do, and I have this 401k I've been putting money into, we'll just say. That money, once retirement happens, can be rolled over into an IRA. If they have any money in a Roth 401k option, then that would be transferred or rolled over to a Roth IRA in order to keep tax preference the same. And then from there, they could invest it in literally anything they want. In fact, there's a few companies out there that allow you to invest self-directed IRA money in real estate. I don't do that. That's not something our company does. That's a very specific niche. I'm in Columbus, Ohio, and there's a company up, it used to be Elyria. I think they're in Lakewood, Ohio, which is just west of Cleveland, called Equity Trust Company. And they're one of the oldest companies or long-standing companies that do this, where you take a portion or all of your IRA, you transfer it over to Equity Trust Company. And then let's just say you've got $1 million in the IRA. Even if you just take $100,000 and you make that a down payment on a property, the entire property value now is in the IRA and it grows tax deferred. So the rent income comes into that same IRA. When you sell it, the proceeds go back into the IRA, and then you can transfer it back to whatever you want, more real estate, go back to the stock market. It doesn't make a difference. So it's all portable. But I'm not sure if that answers your question, but yeah.
Yeah, it does. Like this type of thing won't work for you. That's off the table. It sounds like you guys work with pretty well everyone. Is that
for the most part? Yeah. Anybody who has, I always say that our clients are not a cross section of the economy, because unfortunately Kim, one of my financial advisors, we were just doing a webinar the other day, and for business owners, I think we were looking at the median 401k balance in this country is only $38,000. I think something like that's pretty sad. The mean is much higher. The mean is like over 100,000, but still, that's low. That's really low. Yeah. So our clients are more of a cross section of savers. We always say that we work with a lot of high achieving executives, business owners, successful people who take the time to invest in themselves, take care of their future, and they're looking for good advice.
Yeah, that's interesting. If people want to learn more about your products, your services, how would they reach out? What's the best way to get in touch with you?
Sure. I think the first thing they can do is check out, we have a podcast as well. It's called The Retirement Fiduciary. So you can find it on Spotify, Apple Podcasts, YouTube. So the Retirement Fiduciary podcast is one. Another would be to just look us up online. Our website is libertaswealth.com, and it's spelled like liberty with an AS at the end. So it's Latin for freedom, independence. So libertaswealth.com. And then last, just you can find me on LinkedIn, connect with me personally. If you have any questions, be happy to help out.
Excellent. Love it.